Back with you now on Wave Listens Live. It is a Wednesday, which means it is a Warren Wealth Wednesday, and Marcus Warren is here to talk all about retirement, some things you need to know, taxes, all the big stuff here today. Good to see you. All the big stuff.
Good to see you.
Let's start retirees, a big area of our population that you are able to help, and they always maybe come with some questions.
Yeah.
And so maybe a surprise that comes if somebody's recently retired that, hey, I'm now paying more taxes than I was in retirement, not less. So if you're a successful saver and now you're at that point, a tax problem, maybe you could call it, what do we need to know here?
Yeah, so if you've saved, you've done what you're supposed to do. You've saved in your IRAs, you've saved in your 401ks your whole career, and you've been successful at that. You basically, have a tax problem. And so what do I mean by that? So there's basically, 3 buckets of money or so that you can actually save in. You have your taxable bucket, you have your tax deferred bucket, and then you have your tax-free bucket. We have been told our entire working careers is to defer, defer, defer. So most people have their money saved in that IRA, that 401k bucket. But what they have to understand is that when you retire and you start to pull that money out, you basically have this ticking tax time bomb waiting, meaning that when you pull that money out, you are taxed at your highest marginal tax rate, right? So that comes out and it gets piled on top of all your other income. And so you see the brackets there. Obviously it tops out at 37%, but depending on where you lie in that tax bracket pyramid, so to speak, you're going to have to pay those taxes. You can't get away from those taxes.
You've said it before.
Yep.
You've also said in the past that retirement tax planning, it's like a game of chess with the IRS.
Yeah.
So let's walk through capital gains, Social Security benefits, Medicare premiums, required minimum distributions.
Yeah.
It's all connected.
Yeah, it's all connected. And so think about this. So we just talked about the ordinary income tax rates, right? You've saved in your IRA. You come to a point of time when they make you take your money out, right? That's called required minimum distributions. And so whatever you have to take out, just like I said, it gets piled on top of your income. And those required minimum distributions, they go up each year. So each year you got to take out more of what you've successfully saved upon. So capital gains tax. So there's 3 brackets for capital gains. You have the 0% bracket, you have the 15% bracket, and you have the 25% bracket for capital gains. And I think, right, what's on there now? Yeah, capital gains. So you have 0, 15, and 20%. And it's based on your income, right? And if you have to take that money out of your IRA, it's going to put you in that higher income bracket, right? So you have capital gains that you can be paying a lot more on. Then it doesn't stop there, Brian. Then it goes to Social Security. You're getting Social Security in retirement. And Social Security is taxable depending on your income. And when you have those forced withdrawals, you're going to find yourself in those higher income brackets. So you see there, 0% of your Social Security can be taxed, up to 50% of your Social Security can be taxed, and if you make too much, up to 85% of your Social Security becomes taxable, and it's based on your income, right? So you got that there. And it just doesn't stop there, Brian. There's more. So you also have Medicare premiums. So you have your Medicare. Everyone doesn't pay the same for Medicare, and it is based on that income. And when you're retired and you're getting Social Security and you have to pull money out of your IRA, it can cause your income to go up, and those premiums can fluctuate. So the IRS is playing chess, and if you don't know the game, then you're going to find yourself just shelling out money, like to no end.
Doesn't seem like the game is set up to help people that don't know what they're doing.
Exactly.
Yeah.
Exactly.
Okay. Let's get into inheritance here for a second. Why do you say that leaving a traditional IRA to a beneficiary, if you're doing that, could mean that you've actually allowed the Treasury to become an additional beneficiary in this case?
Yeah, and so generally speaking, just like I said, most people have deferred their income in those IRAs, 401ks. They get to the point where they have to pull that money out. And then they get to a point when they want to leave an inheritance to their kids, right? And what they have to understand is that when they are leaving an IRA, a 401k, a tax-deferred account to their son, daughter, whomever that may be, they are basically giving them another tax problem. What do I mean by that? So when you get that inheritance and you start to take that money out, and by the way, you used to be able to take that inheritance and stretch those income payments out throughout your lifetime, throughout the heir's lifetime. But now the IRS says, you know what? we need money and we need it now. So they've compressed that time. So now if you inherit money in an IRA, you have to spend that money down in 10 years. And so when you take that money out, it is getting piled on top of all of your other income, which in turn throws you up into a higher tax bracket. So my mom, for instance, my mom is in the 12% tax bracket. And if I were to inherit her IRA, so right now she's paying 12% whatever she's taken out. If I were to inherit her IRA, I'm in a much higher tax bracket. So that money, I have to spend it down in 10 years, and now it's getting taxed at a much higher rate. And so there are ways to mitigate that too as you pass money to kids, grandkids, things of that nature.
We kind of got into this a little with the answer there, and we've got about a minute and a half or so left. So let's talk strategies for a second. If we're retirees and we want to address some of these tax challenges we've discussed today, what do we need to do?
So the first thing you can do is, most of people's money is accumulated in that tax deferred bucket. Right now, tax rates are at historically low rates. It might behoove a lot of people out there to take money from that tax deferred account and systematically and efficiently transition it over to your tax-free accounts, Roth IRAs, do Roth conversions, things of that nature. Pay the taxes while taxes are on sale, position your money in those tax-free buckets, and then down the line when taxes go up and taxes are higher, you've already paid the tax at the lower rate. You can also do what's called, if you're taking those required minimum distributions and you don't need it, you can send it to charity if you have charitable inclinations. You can do what's called a QCD, a qualified charitable distribution, have it go straight to the charity. It doesn't count as taxable income.
30 seconds left. For anybody that's been listening to us here today talk about all these important topics and they say, what? I need Marcus. How do we get in touch with you?
Yeah, you can go to talktomarcus.com, set up a quick 15-minute phone call. I can find out where you are, where you need to be, and we can develop a plan to get there. Because retirement is about taxes. We're talking taxes. And you know your stuff. It's not a game. We're talking about taxes.
That's a good one. I'll address that next time. We got to go. See you tomorrow.